How to show little to no income and still get approved for that dream home. See, I believe that most people have been taught that you have to show a lot of income in order to borrow a lot of money. Now, that is a true statement to some, but I'm here to challenge you and to think and to help you think a little differently. So today I'm going to share with you exactly how it is that you can not show income or very little income and still be able to qualify for a loan, because this is the one thing I hear a lot. David, well, I've always wanted to really write off everything and expense this and take this deduction, but every time I try to do that, when I try to go borrow money for a home, they tell me, well, David, you don't qualify. I don't qualify. Why don't you qualify? You don't have enough income. I understand that, and I see it all the time. In fact, just as a full disclaimer, I am also a licensed mortgage loan originator, and so I understand the finance laws and I understand the bank's need to show income. However, there are things that you can do to show the bank that you have money without showing the bank that you made money. Does that make sense? Now, you're probably wondering, is this some trick or is this some scam? To be quite honest, there's no trick or scam here. This is legal stuff. In fact, tax code allows me to take certain deductions and certain expenses as deductions, and those expenses can be used to help increase my income. So first off, I want you to know this video is typically for business owners. These are for people who have a business of some sort, who generate their own income. This could even be people with side hustles or gigs, people who make money as an independent contractor, because you are the people who have the biggest challenge showing and reporting income. See, most of us, when we earn money as independent business owners, when we earn money, we keep that money and we use that money to do two things. Number one, to pay the expenses to operate our business, right? Operating expenses. Number two, to fund our lives. Now, depending on how good you are at making money and how good you are at paying little expenses determines the quality of your life. So if you don't make a lot of money and you have a lot of expenses, you're probably poor. What if you make a lot of money and have little expenses? Then you probably are living pretty well. However, you come to me, the tax man, at the end of the year and say, David, I don't want to look like I'm doing really well because you don't want to pay taxes. And so many people go to a tax preparer, let me use that as a quote, preparer, to file their taxes, and that preparer does everything they can to do what? Say it with me. Lower your taxes, right? We all want our taxes lowered. So we all go to this one guy or gal and we say, hey, help me. And they're the superhero. They're finding every deduction. They're pushing in directions. They're asking you questions, right? Well, maybe not all of them, but they're trying their best. And at the end of the day, they come back to you with the number and they're like, this is what you owe. And you're like, ouch, right? No matter what the number is. And you're like, is there any way I could get this lower? And so they're like, well, tell me about this, or let's look at this. And you take their advice, and sometimes it goes lower, sometimes it doesn't. But at the end of the day, we all know that you've got to report some income. So then you get that document and you say, okay, this is what it is. And then when you go borrow money, the bank says you're broke. And you look over at your tax professional and say, hey, I thought I made money. And they're like, yeah, but you had a lot of expenses. When you're filing your tax return, there are differences between types of expenses that you can deduct in your return. And if you understand that, then what happens is you have the ability for you to be able to use expenses and tell the loan officer, that's not really an expense, that's really income. Imagine that, but don't tell anybody, right? You can actually tell the banker, the loan officer, hey, see that little thing right there? That's really not an expense. That's really income. And the loan officer is going to say, I believe you. We should use that. Imagine that. That's interesting, isn't it? Well, let's talk about this. So there is something called an asset. Many of us have heard this word thrown around. Assets are things that have value, right? Everything that we have that is valuable, like this phone or this microphone or this pen, these are determined as assets. Now, some assets are better than others, right? Depending on the demand for the asset determines how valuable it is, right? Like real estate, for an example. I love real estate. It's a very good asset because it is tangible, meaning I can see it. It is valuable. We can pay a good sum of money for it. And typically it appreciates, meaning it goes up in value over time. And if you're very good with an asset, it distributes cash, right? Now, I'm not going to talk about those type of real estate investments or those assets. I'm just going to talk about those that we purchase to operate and do business. So many of us use things like computers, desks, cell phones, laptops, iPads. All of these things are assets, right? We all use these things to operate our businesses. And if maybe you're in photography, you use a camera. Maybe you are in, maybe welding, you use a welding machine. These are all things that you must buy to operate and do business in the normal course of your business activities. So when you have an asset, by the way, you don't expense it, you do something called depreciate it. You see, depreciation is a deduction that you can take on your tax return that the IRS allows you to take. And what it does is it allows you to depreciate, which means take something and make it less in value over time. So, interesting thing, if you depreciate something, the IRS tells you, based on what that thing is, will tell you you can depreciate it for so long. So for an example, the cell phone. The cell phone is a good example of something you can depreciate. Now, a cell phone has a lifespan or a depreciation method of 7 years based on the IRS code. So if I paid $700, I would get 7 years of depreciation of $100 increments. So 7, 100, 200, 300, 400, 500, and so on. So I get 7 years. So on my tax return, you're gonna see a line that says depreciation, and it's gonna say $100 because I bought this cell phone. Now, the interesting thing is that the IRS has other rules that allow us to accelerate depreciation, called bonus depreciation, or you could call it Section 179 depreciation. These are all technical terms, don't worry about that. Which allows me to take all my depreciation on the cell phone in 1 year. So if I paid $700 for the cell phone, I could actually take $700 as a deduction in year 1. So I don't have to wait 7 years. And I can do this for many things, for my computers, my iPads, my cameras, my whatever asset, something of value that you believe, not paper and stuff, because that doesn't have a very long life, but things that you could use over the course of life. Anything electronic, anything typically that has a useful life greater than 1 year is going to be a depreciating asset. So imagine you as a small business owner, and you've been in business for about 4 or 5 years, and you're saying, hey, it's time to upgrade. And you're like, what do you mean upgrade? Let's upgrade all the computers at the office. And so you decide to go get these really cool MacBooks, right? And you want these Mac towers because everybody loves Apple. And so all that is not very cheap. We all know that. And let's say you spend $20,000 on all this equipment. And now you come to file your taxes. And you say, David, here is my statement that shows how much money I spent and how much money I made. And this is called the profit and loss. And then I look at the bottom and it shows that you have an income of $10,000. And I'm like, okay, cool. So then I start, as a tax professional, start working on your return, and I see you guys bought a lot of equipment this year. And you say, yeah, I did, cool. And I see here that your bookkeeper put that as an expense. Yeah, they did, because we spent the money. Okay, cool. Well, did you know that it's not really an expense, it's an asset, and we can depreciate it? And you're saying, well, what does that mean? Well, what you can do here is I can move it from this side to over here, and I can actually now put it as a depreciating asset. Does that change how much I owe? No. Does it change my income? No, it doesn't do any of that. So why would I want to do that, David? Because depreciation is called an add back when you borrow money. Now, let's say that I had $10,000 as reported income on this statement that you brought into a tax professional. When I borrow money from a bank, the bank will add the $20,000 to my 10, and now I have $30,000 in income. Now, this was just with a small number. Imagine if we did this with a big number. And imagine if your income was, let's say, after all said and done, $50,000 instead of 10. And let's say you bought $200,000 worth of equipment. Now you're probably saying, well, where did I get the $200,000? You don't actually have to pay for it. You just got to be able to get it. So for an example, you could take out a loan, or you can get a line of credit. You can have a credit card. All of these are ways to purchase things. So you could purchase something like a car. How many of you would like to purchase a car for your business and use that dedicated for your business? And let's say you're modest and you want to buy a Toyota Camry for $35,000. What if you only use that for business? And what if I told you that's an asset? What if I told you that we could depreciate that asset? And what if I told you we could put $35,000 as a depreciating asset on your return in year 1 and add that back to your income when you go borrow money? You could actually show no money, zero income, but have spent $300,000 in not one car, but one car and computers and you upgraded your technology systems, your phone system. Everybody got a new phone and you bought new lights for your studio, because these are all things. These aren't fixtures. These are things that you can actually have a life, right? Bought a new cool sign. You bought a new desk. I went hard this year and I spent $300,000. And by the end of the day, it shows that I made no money. But on my depreciation line, it says $300,000. When I go borrow money, the bank looks at that and they say, hey, David, I know you made money because you really didn't spend $300,000. You actually borrowed money to buy that stuff. I know you did. And we're going to add that back to your income. And now you have $300,000 to show as income to buy a house, even though you didn't show the IRS anything. This is exactly how wealthy people leverage their taxes to be able to buy whatever they want. So many people didn't understand this or don't even know this. And so what they do is they take their MacBook or their cell phone and they put it as an expense instead of an asset on their tax return. And that harms them over and over and over again. The way to avoid this is two things. Number one, get yourself a good bookkeeper who understands the difference between an asset and an expense. Number two, work with a tax planner or a tax professional that understands not only taxes, but understands finance. Because if they don't understand finances, they're always going to screw you. They're always going to put you in a position to show no income, and you're going to be dreaming about the house you always wanted forever and ever and ever, telling me, oh, David, one day I'll be able to buy a house when I show income. And then I tell you, well, show income, and you're like, hell no, because I don't want to pay taxes. It's catch-22, guys. You got to show income, but what if you didn't have to show income to show income? You get it? So if you like this tip and you need more, please click subscribe. I'd love to get you on this channel and share more tips about finance, business, and taxes, because you definitely deserve to live a great life and build your own economy.